Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. This is also known as the diamonds. I've left my lines on the chart from last week's report. Interestingly enough, this is one of the rare times that the market has not cooperated with our forecast, or you could even say it the other way around. The market did not pull back as expected. Instead, it rallied and broke over the 20-period moving average, doing so with a double gap higher. It gapped up right here on the 24th, and then it gapped again to a higher level on the 25th. And a lot of this was driven by earnings news surprises, beating the expectations across the board. But interestingly enough, the volume is dropping. And what does that mean? Well, when the volume is dropping as prices going up, that tells us that the buyers are losing some of that momentum. And so I'm going to erase this line, show you that the market is now at a key resistance point right up here. And my forecast for next week is that we will go down to fill these gaps. Now, this is an interesting time in the market right now because a lot of people are getting very bullish about the economy and about what Donald Trump is doing. Whether you like Donald Trump or not, you have to remember that Congress is the body of government that controls the purse string. So if Congress does not go along with the economic plan that Donald Trump has set for the U.S., this market could come crashing down. And I have been approaching the markets very cautiously. I've been calling for a pullback for a long time. Now, our subscribers from time to time do take long positions, and it's okay to have a long-term bearish outlook. You just have to make sure that you're more defensive if prices start to break down below key support levels. And I'm going to talk a little bit more about that when we get to the more broad-based indices. So next is going to be the spiders. That's ticker symbol SPY. And you can see here that the same thing has occurred where the market has gapped up on the S&P. So I'm going to erase all of these lines right now, and I'm going to draw the resistance highs right here. That's where the resistance tops are. You can see that even with the spiders, the volume has been dropping, and there's a gap to be filled right here, right around the 238 level. So I'm expecting next week the markets to pull back at least to the 20-period moving average, and I'll leave that in place right there. Now again, going to the more broad-based index, that's the Russell 2000. Interestingly enough, today on Friday, we had a very big red candle. So we set a new high, but it broke right down below that high and closed with a very, very strong red candle, and that tells us that the sellers came in with force towards the end of the week. So I think that the Russell 2000 is going to continue lower right here, going right back to that 20-period moving average like I mentioned in the diamonds and in the S&P. Now, if we look at the Qs, this is the Nasdaq market through the power shares, QQQ. The Nasdaq gapped up, and when you have the markets gapping up across the board, you could most certainly expect a pullback. That's number one. But number two, if you look at the divergence from this moving average right here, you'll see that this is the widest divergence we've had in a long time. That's called the rubber band effect. Now, we're expecting the market to pull back to fill that gap and go right back to that moving average. Interestingly enough, again, we see that red candle on higher volume, and that tells us that the sellers are now motivated. Finally, the VIX, that's ticker symbol VIX. It's the volatility index for the S&P, and you can see that last week we had a bullish engulfing pattern, and after the failed back-to-back bullish engulfing patterns, the VIX has gapped down. One thing you need to know about the VIX is that unlike regular stocks, the VIX fills gaps 100% of the time. So we have a bullish engulfing pattern right down here at a key support level for the VIX, and we're expecting the VIX to start to rally next week in an attempt to fill that gap. Now remember, the volatility index is a contrarian indicator to the S&P. So if we're extremely bullish on the VIX, we need to be extremely bearish on the S&P. So make sure you keep your stops in place. Make sure you're not taking too big of a long position across the board, and it would be best to take a cautious approach to the market. Now, if you'd like to learn more about what we do at The Market Guys, just go to themarketguys.com, click on the video tab right there, and that'll bring you to the library of videos called Market Shots. And you can see that right here, you scroll down just a little bit on the right-hand side, we see the rubber band effect. That's a very short video that will talk more about what I've just mentioned with price divergences from that moving average. And feel free to also explore trading the gap so you can understand how gap trading works for you and for your trading strategy. So that's it from The Market Guys. Have a great weekend, and we'll talk to you soon. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.